Now on Sky News Business, this is Trading Day Live.
Hello and a warm welcome to Trading Day Live. We're just on 12 p.m, 2 hours into this session. I'm Leanne Jones, and a quick check on the ASX 200 there. It is in the red. We're currently down just over 18 points or 0.3%. Materials, the worst performing sector, currently down 1.9%, and energy not far behind that as well. So energy and materials really dragging the market lower there today. If we have a look at company news, it's all been about those reports today. All eyes on Origin Energy in that materials and energy space. It's currently down about 7.5% on the back of its full year results. Also making news this hour.
A crucial question though for the telcos, and this is exactly the strategy that we've been on, is how do we put ourselves in the best possible position to take advantage of that? And that's the journey that we've been on. And
Telstra CEO Andy Penn points to 5G as the future of his company, as shares saw 5% on the back of its full year results today. And jobs data coming in for the month of July, a small beat. That headline read, the unemployment rate dropping to 5.3%. We will have more analysis on that this hour. A bit of a mixed read there, the drop in the unemployment rate to 5.3%, but the overall move in jobs was a move to the downside against a rise of 15,000 that was expected. So somewhat of a mixed reading there, but certainly just watching this weakness on the ASX 200. As I say, we are 2 hours into this trading session. It is energy and materials right down the bottom of the list there today. Let's get you across some of those big stories. Of course, the broader moves on the market. Chris Conway from the Australian Stock Report joins us live from our Melbourne studio. Chris, good to have you with us today. We want to delve into all of those company reports, but for now, just a thought on the broader index. We're down about 0.3%. Of course, noting that we are coming off the back of those fresh 10.5-year highs that we saw yesterday. Is this just a natural pullback? What are some of the big factors that are contributing to that move there today?
Good afternoon, Leanne. I think obviously the leads from Wall Street is really why we were down today. It's been nice to see the Aussie market sort of rally off the early lows. And again, we sort of, we are being absolutely driven by company results, which although some have been unexpected and some of the reactions have been particularly unexpected, on the whole have been positive, and that's what's got us above 6,300 in the very first place. So we continued to be supported by what so far has been good company earnings, and with any luck we'll close today back above that 6,300 level.
Can we talk about some of those company earnings, and Telstra really at the top of the list there today? A good rise for those shares, down up 4.7% at just above $3. But again, this is putting things into context, because over the past year, those Telstra shares have really been hammered. I mean, there's been big headwinds facing not just Telstra, but the whole telco sector, it's fair to say. Heading into that result, expectations were probably pretty low. What have you made of the result, the move today, and how you're positioned on Telstra going forward?
I think what investors really need to do with regard to Telstra, Leanne, is make sure they separate today's results from what the future looks like. Like you say, the expectations heading into the results today were very low, much like they were with CBA. Everyone was sort of expecting it the worst, and that when they didn't come out the worst, CBA rallied, and obviously Telstra is rallying today as well. So you give the results today a tick, but then you look forward to what the strategy is out to 2022, whether Andy Penn's the right guy to be running the company, whether it's the right strategy, how they're going to fill holes in mobile revenue, how they're going to fill holes in NBN revenue, whether the dividend is sustainable, which is very unlikely according to most on the street. So yeah, like I said, you need to separate what's happened today with some good results and a nice 5% pop with what the outlook looks like over the next 1 to 3 years, and it's still not very rosy. What I would say about Telstra though is what they've done with today's results is they've bought some more time, and I think that is important. So the Wolves are at the door. They bought themselves more time though to execute a strategy that is going to be meaningful to achieving some good results in the future.
You say there that it is important to separate out the results from what the future looks like. Do you think there is any more clarity? Because today Andy Penn did say that those trading conditions are expected to remain challenging, much like what we've seen in FY18, that is expected to continue into FY19. And it seems to be what a lot of analysts are pointing to is those competitive pressures across the whole telco sector. So is that the number one challenge for Telstra going forward here, those competitive pressures that Andy Penn even points out today?
Yeah, absolutely it is. I mean, here in Australia, you know, we've got a finite market. Well, when I say finite, I mean a relatively small market. 25 million consumers, or 25 million population, I should say, not that many, not that many telco customers. But it's, you know, it's been carved up between a whole host of players. There's probably too many players for the size of the market that we have. So those competitive pressures are going to remain. What I did take out of what Andy Penn was saying this morning just before I had to leave for the studio, though, is we are actually all consuming more telecommunications products. We're consuming more data, we're more interactive, we're consuming content when we want to see it on mobile devices. So the demand is likely to go up. What Telstra has to get right, though, and they haven't gotten right to this point, I dare say, is they haven't got the offering right, and perhaps they haven't got their pricing right. Came out with some new pricing models recently. Their competitors are likely to react to that, and that's that competitive pressure, certainly, that you're talking about, Leanne, that will remain a constant, even if we do see some rationalisation of the players within the space. So, yeah, absolutely, that's the big thing. But there is some light at the end of the tunnel, and like I was reiterating of what Andy said, that, you know, there is a surging demand and there will be increasing demand for telecommunications services. So that is potentially the shining light at the end of the tunnel, like I say.
And it's not just Telstra, would you say? I mean, would you look elsewhere in the telco sector if you consider the likes of TPG or Vocus, or do you think it is just really a sector pressure, you know, with those competition pressures, you wouldn't look across the whole sector? What's your view sort of even outside of Telstra?
Yeah, look, I don't play in that space, Leanne, not because I'm opposed to it, just because it has been the underperforming sector for, I think, the last 2 years now. And when I say underperforming, I mean underperforming by a long way. So I just simply think personally there are better opportunities out there that are worth pursuing ahead of anything in the telco space. Certainly there will be a point, though, where these stocks have fallen far enough, and maybe, as I said, some rationalisation in the space with mergers or acquisitions where it will look more attractive, but I don't think we're anywhere near that yet.
Let's talk another big mover there today, QBE. It's up almost 7.5%, and it looks like it's been a good beat on all of those metrics from the company. Higher gross written premiums. I suppose the higher US dollar also helping out its bottom line. What did you make of the result from QBE? Do you like this one going forward? Obviously does have that leverage, I suppose, to the United States, but a big move in shares today.
Yeah, look, there's a shopping list of factors that have helped QBE over the last 6 to 12 months. As you say, the US dollar, which helps their investment earnings, which have been on the increase. Their margins have expanded because they have raised the cost for their insurance products, and there has been more consumption of those insurance products as well. Just from the qualitative side, they have hived off some underperforming assets like Latin America, Thailand, Hong Kong, and focused away from catastrophe insurance to more sort of commercial annuity style insurance, which seems to be a more sort of stable model. So yes, like the results today, this was one of the ones that we had in our reporting season guide that we were expecting to report ahead of expectations, which they have done. The caveat with this one always, though, Leanne, is it takes just one catastrophe to wipe out, 6 or 12 months worth of good work. We've seen it in the past. Anyone who's holding QBE, ourselves included, need to have everything crossed that there aren't any natural disasters, let alone for the, obviously the human cost, but also the cost to the share price that would come.
All right, let's move on to Treasury Wine Estates. TWE, of course, a rise of just over 3% there for the stock, and it looks like it was perhaps a beat on expectations. So leveraged, obviously, to the increasing demand for wine, certainly in China. And, we were receiving some commentary this morning, a lot of analysts saying, look, it's obviously very well positioned to take advantage of those leverage opportunities. Your view on a Treasury Wine Estates going forward, because obviously that looks like a big market for it, a big opportunity there across Asia.
Yeah, absolutely. They grew the Asian division, I think it was by 39%, which is exceptional growth. The negative, and look, that's probably why the stock was down this morning, was down 5% off the open, now up 3%, so it has been a fantastic turnaround just even intraday. But I think the early worries, pardon me, was that 11% decline in the US division. Pardon me, Leanne, sorry. 11% decline in the US division, and that was a bit of a surprise because they had spent more money on marketing there, and we're anticipating that division to grow, and we're also expecting the translation effect of obviously earning in US dollars and bringing those profits back home. So that was a bit of a miss, but they also sort of restructured the distribution network of that division, which, you know, I think analysts didn't like early this morning, but obviously are viewing it as a transitory factor, one that won't repeat in future periods. So yeah, look, we quite like it. It has had a strong run in the share price. But look, beat on numbers today, and really the growth engine is China and that Asian division, and if that can remain strong, there's no reason why the share price can't continue to head north.
All right, excellent. Now, we've been talking all the positives, it seems, with Telstra, QBE and Treasury Wines, as you say, that good reversal now into positive territory. One that's not doing so well, though, today is Iluka Resources. It's down about 5.7% as I look here. Their net profit, well, a return to profit, and really this has been on the back of higher mineral sands prices. But it seems like the market, well, hasn't responded all that well today. Is that because the numbers perhaps weren't quite as good as what the market was expecting?
I think that really is it, Leanne. You know, it was on the face of it a very strong set of numbers, and you know, further evidence that they're, albeit late stage, and when I say late stage I mean compared to the likes of BHP and Rio and some of the bigger commodities players, but a late stage turnaround is now complete. So yeah, a strong set of numbers, but just fell short of, you know, what were very lofty market expectations. And again, the share price had a pretty good run. But I think these results again speak to the operational improvements and the operational performance, which has really gotten better over the last really 12 to 24 months, and places the company in a really good position to continue to benefit from, as you say, elevated prices for their commodities. So look, probably we think a little bit of a buying opportunity. Depends on how the brokers, of course, react tomorrow, because it might see a bit more downside weakness. But you know, it is a big slump in the share price, you know, sort of 8 to 10%, which if you get the timing right could provide a trading opportunity.
Excellent. Chris Conway, it's been a pleasure. We really appreciate you joining us today, and we'll look forward to talking again soon. Thank you so much.
Thanks, Leanne. Cheers.
Chris Conway there from the Australian Stock Report.